Welcome to the Byte-Size Brief. Today we are putting RDDT, that's RDDT, completely under the microscope. Let's get into it.
Yeah, let's do it.
So imagine this scenario for a second, right? You're a tech company. You just posted an absolute, total blowout for your fourth quarter. You grew your revenue by a massive 70% year over year, like totally crushed Wall Street's expectations for your 8th straight quarter.
Right, 8 in a row.
Yeah. And what is your reward for all this? You get to watch your stock price get slashed nearly in half. I mean, welcome to the absolute whiplash of being an RDT investor right now in April 2026.
It really is a staggering disconnect between the headline numbers and the market's actual reaction.
Oh, totally.
Because late last year, around September, we saw the stock riding a wave of just immense optimism, hitting an all-time high in the $270 range.
Yep, it was flying.
Exactly. But you fast forward to today, and we're looking at a valuation that has plummeted down into the 130s, 140s range. I mean, Wall Street is just aggressively repricing the company.
And that is exactly what we're here to unpack today. Because on paper, the engine looks like it's roaring.
It's on paper.
Right, but the market is heavily discounting the stock. So we're going to dig into the underlying data to figure out if RDT is like a misunderstood growth engine on sale, or if the market is correctly pricing in some hidden structural risks that everyday retail investors are just missing.
And there's definitely a lot under the hood to look at.
For sure. Okay, so compared to last quarter, what actually moved the needle here? Because looking at the data, the massive jump in average revenue per user, or ARPU, that completely jumped off the page for me.
The ARPU spike.
I mean, it spiked 42% to $5.98.
Right. And I wouldn't call that metric a pure victory, though. I mean, it's an impressive top-line number, obviously. But if you look closely at the underlying user mix generating that revenue, there is actually some, critical deterioration happening beneath the surface.
Wait, deterioration? How so?
So let's look at the actual human beings on the platform. They hit 121 million daily active users in the fourth quarter.
Right, which is a 19% jump year over year, which sounds like incredible momentum, for a platform that's been around for 2 decades.
The total volume is growing, yes, but the quality of that volume is shifting dramatically. Right now, logged out users make up 58% of that daily audience.
Wow, more than half.
Yep. And what should really catch an investor's eye here is that this logged out cohort is growing twice as fast as the logged in users.
Let me stop you there because I hear this thrown around a lot. A view is a view, isn't it?
Well,
like if I'm walking down the street and I look at a billboard, the advertiser still pays for my eyeballs, even if I am not wearing a name tag, right?
Sure, but
So why is digital advertising punishing RDT for having massive growing traffic just because people haven't typed in a password? Hold on, how does that actually affect RDBT's stock price for regular investors like me?
Okay, so because digital advertising doesn't operate like a billboard, it operates on certainty.
Certainty.
Yeah. Think of it as the difference between a highly targeted direct mail catalog and just like a flyer jammed under a car windshield wiper.
Okay, I like that.
When a user is logged in, RDDT has a deterministic identity graph. They know that user A subscribes to a marathon running community, upvotes posts about carbon-plated running shoes, and spends, 40 minutes a day in fitness threads.
Right, they have a whole profile on them.
Exactly. And advertisers will pay a massive premium to send a targeted ad directly to that specific user.
Makes sense.
But a logged-out user arriving from a search engine, RDT only knows what specific page they are looking at in that exact second. They are just a car in a parking lot. You can put a flyer on their windshield, but you cannot charge the advertiser a premium because you have literally no idea if the driver actually cares about running shoes.
Oh, man. So basically, it's kind of like having a mall completely packed with window shoppers who refuse to sign up for the loyalty card.
That is a phenomenal way to look at it, yes. The audience is swelling, but it is swelling with the lowest value traffic possible.
Yikes.
And this is compounded by where this growth is happening geographically. Like, in the United States, daily active user growth has slowed down to just 9%. Meanwhile, their international user growth surged by 31%.
Which again, sounds great on a press release.
Well,
global expansion.
Right. Until you look at the monetization gap. The average revenue per user internationally is only $2.31.
Ouch.
Yeah. Compare that to the U.S. market, where the ARPU is $10.79.
That's a huge difference.
It's massive. So they are growing fastest in their least profitable geographic segment, with users who are increasingly refusing to make accounts. And this leads to a very concerning shift in corporate transparency.
What do you mean?
Management recently announced that by the third quarter of 2026, they are going to stop reporting the split between logged in and logged out users entirely.
Wait, really? If I'm an investor, you're telling me management is intentionally turning off the lights on the one metric that shows whether their audience is actually monetizable. That feels incredibly defensive.
It certainly suggests they anticipate that the logged out ratio will just continue to grow and, they want to focus Wall Street's attention away from the user mix and more toward total top of funnel traffic.
Yeah, look at the big shiny number instead.
Exactly. But if you have an audience of windshields like we talked about, you have to completely overhaul how you deliver those flyers. This user mix dilemma is the exact catalyst forcing RDDT to frantically modernize its advertising technology.
Which perfectly explains the massive push we're seeing into their ad stack right now.
Precisely.
Because if you can't rely on users giving you their data voluntarily by logging in, you have to build better traps to figure out if your ads are actually working. I was looking at the recent rollout of their conversion API or key API and their dynamic product ads.
Yes. And to understand why this is a game changer, we have to look at the mechanics of the broader internet for a second. For years, digital advertising relied on third-party cookies.
Right, those little tracking codes.
Yeah, little pieces of code in your web browser that tracked you from RDDT to a shoe retailer's website. But with privacy crackdowns and Apple's app tracking transparency, those cookies are essentially dead.
They're gone.
Right. So RDT lost visibility into whether an ad actually led to a sale. The conversion API fixes this by bypassing the browser entirely.
Okay, let me make sure I'm getting this mechanism right. Instead of relying on my web browser to tell RDT that I bought those shoes, the shoe company's actual checkout server whispers directly to RDT's server behind the scenes.
That is the exact mechanism, yeah. It creates a secure server-to-server connection. So even if a user is logged out, if the advertiser can match an IP address or a device ID, RDDT can prove to the advertiser that the ad drove a purchase.
Sneaky but effective. So basically, RDDT is finally giving advertisers the basic tracking and shopping tools that the rest of the industry has had for years.
Exactly. You add in dynamic product ads, which automatically generate shopping ads based on a brand's live inventory, and you suddenly have a modern platform. And because of these rollouts, performance advertising now makes up 60% of their total ad revenue.
Performance advertising meaning ads designed to trigger a specific action, not just brand awareness.
Right, exactly.
And their active advertiser base grew by 75% year over year. They also just launched the beta for Reddit Max, which is this new AI-powered campaign tool. The initial data showed it reduced the cost per action for advertisers by an average of 17% in testing.
A 17% drop in cost per action is massive for an ad agency.
Yeah, while bumping conversion volume by 27%.
Right. It means acquiring a paying customer just got significantly cheaper, which is why you see Meta and Google dominating this space because they've had this tech liquidity.
Right, but what does all that actually mean for RDT investors? Because let's be honest, Meta and Google have had server-to-server tracking and dynamic ads for half a decade. RDDT is essentially just installing indoor plumbing while the rest of the industry is building smart homes.
That's a fair point. They are absolutely playing catch-up. But from an investment perspective, that catch-up phase represents a massive remaining runway for revenue growth.
How so?
Well, many of RDT's largest advertising clients, and we are talking massive global holding companies with hundreds of brands under their umbrellas, have still only activated a tiny minority of their brand portfolios on the platform.
Because the tracking used to be so bad.
Exactly. Historically, an ad agency might run a test budget on RDDT, see poor tracking data, and pull the plug. But now that the tracking actually works, RDDT is in a position to capture a much larger share of those existing clients' total ad spend.
They don't even need to find new advertisers.
Nope. They just need their current ones to open their wallets wider.
Okay, that is a compelling bull case for the advertising side of the house. But, advertising is notoriously cyclical, and it relies heavily on a booming economy.
Very true.
Luckily, for RDT, advertising isn't the only way to monetize 20 years of human thought anymore. we have to talk about the data licensing deals, because this might be the most fascinating and probably most dangerous part of their entire business model right now.
Ah, yes. The other revenue category.
Yes.
In 2025, this segment generated $140 million, driven almost entirely by data licensing deals with major artificial intelligence developers.
Yeah.
We're looking at roughly $60 million a year from Google and an estimated $70 million from OpenAI.
And the logic here is completely bulletproof. Steve Huffman, the CEO, calls it his ass-in-seat philosophy. Because the internet is rapidly filling up with AI-generated sludge. Bots talking to bots, automated articles, fake product reviews. In that environment, RDT's 20-year archive of authentic human-to-human conversation becomes an incredibly rare commodity.
It really is the ultimate moat. Think about it. If you are training a large language model and you want it to understand nuance, sarcasm, or how humans actually troubleshoot a complex problem, you need high-quality human dialogue.
You can't just feed it Wikipedia.
Exactly. But it's not just the text. It is the structure of RDT itself. The upvote and downvote system acts as a massive, crowdsourced reinforcement learning mechanism.
Oh, wow. I didn't even think of that.
Yeah, the AI model doesn't just read a million answers to a coding question. It knows exactly which answer the human community deemed the most accurate because it has 10,000 upvotes.
It is pre-labeled training data generated by 500 million people for free.
It is a totally unique asset. But we do need to look at the severe vulnerabilities threatening this revenue stream.
The bears are entering the chat.
Exactly. First, you have an intensifying regulatory storm. The EU AI Act places strict guardrails around how data can be scraped and utilized. Regulators in the UK and the Netherlands are currently probing whether selling user-generated content for commercial AI training complies with existing privacy laws.
Because the users didn't explicitly opt in to train an AI.
Right. If regulatory bodies force RDT to implement strict default opt-out mechanisms for its users, the volume and value of that training data could plummet overnight.
Yeah, if the users pull their content, the gold mine runs dry.
Exactly.
But there's a second risk here that feels much more immediate, and it involves their biggest data customer. I was reading that an estimated 40 to 50% of all RDT's daily traffic currently comes directly from Google search.
This is the asymmetric dependency that is currently terrifying Wall Street.
Wait, so Google pays RDT for their data, but then uses that exact data to generate AI overviews at the top of the search page. Doesn't that mean a user gets their answer without ever clicking the link, totally killing the ad revenue we just talked about?
Yes, that is exactly what it means.
But wait, if they never click the link, they never see the ads. They're essentially selling the rope that Google is using to hang RDT's search traffic.
You have isolated the exact structural risk the market is pricing in right now. It is a highly parasitic relationship.
It's crazy.
Google desperately needs the conversational data to keep its AI models relevant, but RDT relies on Google for up to half of its top-of-funnel visitor acquisition. If Google's AI summaries intercept even 10 or 15% of that search traffic, specifically those logged-out users who are just looking for a quick tech support answer or a recipe that is a catastrophic direct hit to RDT's ad impressions.
And suddenly, that $60 million licensing deal from Google looks less like a revenue stream and more like a massive discount on stolen ad revenue.
Exactly. The market is running the math, trying to figure out if the fixed licensing revenue will ultimately offset the potential compounding loss in ad revenue from intercepted search traffic.
And if that top-of-funnel traffic is at risk, it puts a massive spotlight on the company's actual underlying financials.
Which brings us to the actual cash.
Yes, because if the traffic funnel gets squeezed by Google AI overviews, RDDT's balance sheet needs to be completely bulletproof. Let's lift the hood on these financial mechanics, because when you look closely at why analysts like Truist recently downgraded their targets, the engine looks a little different than the shiny exterior.
To understand why the stock is sitting in the 140s after a massive revenue beat, we have to look at the hard data surrounding their cash flow and how they actually define profitability.
Okay, lay on me.
In their fourth quarter earnings, management celebrated generating $684 million in free cash flow for the full year of 2025.
Which sounds phenomenal for a newly public tech company.
On the surface, yes. However, their stock-based compensation, or SBC, was $343 million.
Wait, I want to slow down here for the listeners because this is where retail investors get crushed. If you own shares of RDT right now, management is telling you they generated $684 million in cash. But what they bury in the fine print is that they literally gave half of that value away to their own executives and employees in the form of new stock.
Yes, stock-based compensation is a non-cash expense, which is why free cash flow looks so high, but it is a massive dilution of shareholder value.
That's brutal.
The headline free cash flow number significantly overstates the actual value equity holders get to claim. And there is a second layer to this profitability illusion that the market is really beginning to wake up to. RDDT reported a very impressive 24% net income margin.
I mean, 24% is fantastic for a social media company.
It would be if it were permanent, but that margin is currently artificially shielded by $1.7 billion in federal net operating losses, or NOLs.
Okay, hold on. How exactly do net operating losses mechanically work to boost their current profit?
Sure. Think of an NOL like a massive tax credit punch card that a company earns during its startup years. For over a decade before going public, RDBT was burning cash and operating at a heavy loss.
Right, they didn't make money for years.
Exactly. The tax code allows them to carry those historic losses forward to offset their current tax bill. So right now, despite reporting millions in net income, they are paying effectively zero federal income taxes. They are just using punches on the card.
Wow. But eventually they run out of punches.
Precisely. Once those NOLs are exhausted in a few years, a massive chunk of that reported 24% profit margin will suddenly vanish to the IRS.
Oh, man.
The market is looking ahead, realizing that the current profitability profile is uniquely insulated by tax shields that will not last forever.
That completely changes the math for anyone looking at their price-to-earnings ratio. It looks cheap now, but only because the tax man hasn't arrived yet. And speaking of people cashing out before the music stops, we have to talk about the insider activity because the data here is honestly alarming. Over the last 6 months, the ratio of insider trading is staggering.
It really is.
342 insider sales versus only 4 purchases. Executives, including the chief operating officer and the chief technology officer, have been cashing out tens of millions of dollars worth of stock.
It is a notably heavy volume of selling. Now, to be objective, some of that is driven by pre-planned 10b5-1 trading plans.
Right, the automatic sell schedules.
Yeah, which are routine, automated schedules executives use to sell stock without triggering insider trading red flags. But the sheer volume of sales, juxtaposed against a virtual absence of insider buying, does not project confidence to the retail market.
And this is where I start getting skeptical. Because, so basically, it's kind of like they are printing massive amounts of new shares to pay their executives, and then using the company's cash to buy those shares back through this new $1 billion share repurchase program. Is this a house of cards, or just standard operating procedure for a newly public tech company?
It's a valid concern. Buybacks are frequently used to offset the dilutive effects of heavy stock-based compensation. By reducing the total number of shares on the open market, a buyback artificially props up the earnings per share metric.
So it looks better on paper.
Right. However, it is vital to maintain an objective, balanced view of the entire balance sheet here. Despite the heavy dilution and the insider sales, the underlying financial foundation of RDT is actually incredibly robust.
Okay, what's the bull case for the balance sheet then?
Well, they maintain zero debt.
Zero, wow.
Zero debt. They are sitting on a fortress of $2.5 billion in cash and equivalents. And perhaps most importantly, they operate with a phenomenal 90% gross margin.
90%.
Yes. Why? Because unlike Netflix or Disney, RDDT doesn't have to spend billions of dollars producing content. Their users create the content for free.
That's a great point.
So while the $1 billion share buyback program does offset executive dilution, it also serves as a massive signaling mechanism. Management is demonstrating intense confidence in their ongoing underlying cash-generating ability as they head into their critical first quarter 2026 earnings report this coming May.
Man, it really is a fascinating tug of war. On one side, you have zero debt, 90% gross margins, and a massive runway to monetize their ad stack. On the other side, you have worsening user quality, tax illusions, and Google actively attempting to eat their search traffic, which leaves us with a brand new angle to mull over as we wrap up this deep dive.
Where do you see the platform evolving to escape this trap?
Well, think about the macro trend of the internet right now. The web is fragmenting. Users are exhausted by algorithmic AI-generated feeds, and they are increasingly craving deep, highly specific, authentic human communities. If Google search traffic becomes unreliable, could RDDT eventually introduce premium ad-free subscription tiers? What if they rolled out exclusive, paywalled subreddits for high-value professional communities?
Interesting.
Like imagine a verified community of cybersecurity engineers or corporate lawyers where users pay a monthly fee for access to elite, ad-free human networking.
It is a very compelling thought experiment. The intrinsic value of verified human connection and niche expertise is only going to skyrocket in the AI era.
Exactly.
Transitioning from an ad-supported eyeball business to a premium subscription community could entirely bypass their reliance on Google traffic and traditional advertising bottlenecks.
Right.
How RDT chooses to monetize that human value will undoubtedly be the defining story of the company for the next decade.
All right, listeners, what's your take on the future of RDT? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Bite-Size Brief.